Welcome, Task 4, Credit Management AAT Level 4. I hope you're looking forward to some fun here. My name is Rob. We are going to look at one of the fundamental tasks that you have to get right in order to be successful in your AAT Credit Management Assessment. I need your feedback. I need you to help me with this. It's not about me, it's about us making sure that we can do the right thing. Let's launch straight into it and see what it's all about. Now, what we have in front of us is a practice assessment that you should be quite familiar with, because this was the practice assessment that was started last time by David, where he looked at such exciting things as, well, if you look at the note there, write notes to brief a new member of the credit control team explaining the sources of external information, blah, blah, blah. So that's what he talked about last time. But it's such a large assessment that we're going to address it again, because there was a further thing he did in terms of the role of the sales director. Can you see at the top there? So I'm not looking at that. But this assessment keeps on going. It keeps on giving, if you wish. Now, what I want to do is to first of all go to what the requirement is. Can you see the vast amount of information that we have? Now, it's a pretty basic requirement. Write a note analysing the information and recommend whether credit should be granted. Okay, so that's what we have to do. And I told you it was important from the perspective of your assessment, and you can see the fundamental reason why there are 22 marks that you have to earn for this particular assessment. Now, what does the AAT say about this task and how well it has been done by you? Well, it says that in general, 60% of people are competent, something around 60% on this task when they do it in the exam. It's not very high, 60% from my perspective. And I think it's reflective of the issue that we all have in relation to the discursive areas of the course. So before we get into the detail, because there's a lot going on here, before we get into that, what I want to do is, first of all, think about how we're going to deal with one of these analysis type questions. So, how are we going to score those 22 marks? Where are those marks coming from? Any thoughts from you? How do you score the big marks in this sort of paper, please? You're all dumbfounded by MDCL that came up before, but we're talking about credit management now. This is far more interesting than anything that you studied earlier. Well, okay. The first issue is this. We've got to do the analysis itself. Now, if you think about it, the way that these assessments work is that the ratios have been calculated. So the first thing we have to do is to comment on the data. And the data includes, on the one hand, the pre-calculated ratios, but also, as we're going to see, we can look at the wider financial statements. Okay? And we want to make some pretty basic observations there. When we comment, this is what we are going to talk about. It's not going to be difficult stuff. We're going to say, has the number gone up or down? Is it bigger or smaller than it was before? Not difficult. But that on its own doesn't mean anything. We've got to then say, is that a good or a bad thing? Okay, so that's the first thing we're going to do. We're going to say, this has gone up and that is a good thing. It is an improvement, or this has gone up and it's a bad thing, depending on exactly what the information is. Now, that's the first. Then, once we've done that, by far the most important thing that we're going to do is we're going to say to ourselves, so what? What does that mean? And this is where the big marks are earned, okay? What does that mean in context with the question? Now, we have to remember what this question was asking to begin with. You see, we want to know whether or not we should grant credit. Nothing more, nothing less. So every single time that we look at this, what does this mean? The focus is going to be on credit worthiness. Do we think that this company has become more or less credit worthy, and hence should we still give them credit? That is the deal. So it's not a difficult idea, but if you're not talking about that, stop and get back to talking about that. Okay, so that's the simple idea. That's what we're trying to do. But where do those 22 marks come from? So if we go back to the question proper, now let's look at the information that we are given. Okay, so, if we're going to look at the information given, sorry, this is annoying me. What we're told is this. Let's go back to the top. We are given a statement of financial position, balance sheet. Okay, interesting information there that maybe we can look at. We're also given a P&L account. Fine, also information there. And what we want to do, further, we're given some pre-analyzed data. So don't think you have to calculate these ratios again. We've got such exciting things as gross profit margin, operating profit margin, and so on. Okay. Now, the final thing that we've got is this, the following information. Now, I think we're going to have to read through this. There is a slight problem here, but we're not going to make it a problem. We're going to make it an opportunity. The following information has also been provided. Berlin sells catering supplies, but also hires out large equipment and machinery. Up to 20x4, much of Berlin's plant and equipment was acquired by means of finance leases. But from 20x5 onwards, most of the equipment is acquired by using operating leases. Now, there is a slight issue here because anybody who's up on leasing will appreciate that the concept of operating leases has disappeared. But because this is an AAT own assessment, I feel that we should still use it because it's the crux of the question. So my question to you is this. Moving from finance leases to operating leases, what's the fundamental difference? Well, I can hear you all shouting what the fundamental difference is, but I'll tell you anyway. That is that what happens is that the assets go from being on the balance sheet to off the balance sheet. So what we should see is a considerable change in the non-current assets. That should fall because they disappear off the balance sheet. But consequently, we would expect somewhere in the credit side also to fall, and typically this would be borrowing. Okay? So we would expect a fall in the assets and a fall in the liabilities, something like that. Okay? Now, we're then told non-current assets acquired under finance leases are shown in the statement of financial position with the corresponding liability shown as part of borrowing. So, what we know, we didn't have to because it's already given here. Then we're told interest charges on finance leases are included in the finance costs. Okay. Whereas non-current assets acquired under operating leases are not shown in the statement of financial position, and payments related to operating leases are included in the cost of sales and disclosed by way of a note. So, can we see any of that happening? Because, of course, this is going to be fundamental to what we talk about later. So, if we were to go up, let's start with our statement of financial position. We said that we expected the non-current assets to fall, and boy, do they fall. They fall by something like 46%. Wow. Okay. And critically, when we look at the borrowing, so if we go down and look at the borrowing, we see a similar, quite dramatic drop in the borrowing of something like 6.4 million. And of course, the whole point of this to you as someone assessing credit is that maybe there are alarm bells ringing because you are not able to understand completely what is happening. Okay? Understanding completely what is happening with regard to the financial health of the organization. That would be my understanding. Now, that's one aspect. If we go to the P&L, we should expect a substantial increase in the cost of sales because we've got more interest charged there, and a substantial decrease in the finance costs. And it's a bit weird this, we don't see the cost of sales going up that much. We're expecting it to go up more, but it's not happening. But we do see a fall in the finance cost. Okay, so we're sort of seeing something here, but if you look at the overall cost of sales, distribution and admin, because of course other things may have changed as well, I think you see that there is quite a significant increase in the overall cost base above the operating profit, all the operating costs there. Okay, so that's the first thing we've got, but we've got to get rocking and rolling. Now, if you think about it, we were asked to look at whether we should offer credit. Now, more specific than this, we were asked to look at it in 3 ways. And this was put at the top of the question, right at the very beginning. Remember, we're only doing half of it today. It specifically says that we should assess it in terms of profitability, in terms of liquidity, and in terms of gearing. And I don't know about you, but I can see a way that these marks are coming from, yeah? Because I can see that, well, hold on, if I go for 5 and 5 and 5, and then I look at an overall conclusion, I'm going to do okay. Yeah, 5 for each. If I can get more than that, that's great. So let's look at this in a little bit more detail with regard to, well, let's start with profitability. Okay, so if we're looking at profitability, we were given the ratios. And we see that the gross profit margin has slightly increased, the operating profit margin has fallen, interest cover has materially increased. We've got 3 profit ratios. So what we want to do is to comment on those. Is there anything else that we could comment on just by looking, say, at the P&L account? Well, I think there is. You see, I was thinking possibly we could just simply say, has it gone up or down, the sales revenue? And if we look at the sales revenue, we see that there's something like a fall of 1,040,000. Yeah? A fall of 1,040,000. More than that, we could say that there's been a fall of 3.5%. Is that good or bad? Another thing to say. Gross profit margin. What we see, it's fallen as well. It's fallen by 190,000. I suppose I should put minus and minus here. 3.1%. Yeah. And the operating profit margin has fallen by 770,000. 25%. Wow. Now, why could that have been? We don't really know, but we've got to suggest reasons. Now, one reason, looking down here, comes back to the fact that the interest costs are now in the operating costs rather than below in the finance costs. That's very plausible, okay? So, how do we get this down? Now, it's in the limited time we have here, it's difficult to know how much we can get down in total, but let's look at something like this. Okay, so we were talking about, let's get the right color, we were talking about the ratios, yeah, and we could say something like this: gross profit, and net profit margins have fallen. Net profit by 25% to 7.23%. Yeah? This is significant. Now, that's an important point to state, because we're saying it's important, whereas a smaller rise or fall would not be important, but may solely reflect the interest charges that were formerly in finance costs, now being in operating costs. So we've got to come up with a really powerful idea here, and I'm expecting 2 or possibly squeezing even 3 marks there. We've talked about significance, and we've talked about a specific reason why things may have changed. Okay? We could then say something like this: interest cover has more than doubled. Because if you look back at interest cover, it was 1.85 and it's now 4.25 times. To 4.25 times. Which suggests, now I think it's always incredibly useful to use this sort of idea. We use the terminology which suggests, because it forces us to then suggest something. Okay? So 4.25 times, which suggests that we can comfortably cover interest costs. And again, is the result of moving to operating leases. So, I reckon I've scored at least 4 marks here, and hopefully a little bit more. I hope. We shall see. Okay. What else can we talk about? Well, we could just talk about the bald figures. What about our sales? Overall, sales revenue is slightly down. And this feeds through into reductions in profits earned. Which is not a strong performance, but in itself does not represent an increased credit risk. That's my opinion. You see, this is an area where you have to have an opinion, and all I'm saying is that profit's a small amount down, but it's not that important in the wider scheme of things. So, I've done something on profit there, okay? We can do profit, that's very straightforward. So, we've looked at profitability. Now, let's just move on and look at, well, if we were to look at, say, liquidity, what are we going to talk about? Now, liquidity from the perspective of, pardon me, I've gone too far there. Liquidity from the perspective of creditworthiness, we are given the following pieces of information. So we're given the current ratio, fine, and we see that the current ratio has gone up. Is that a good or a bad thing? Hi Sudhir, how are you? Is it a good or a bad thing? Well, I'm going to say that that is a good thing. If the current ratio has increased, the amount of current assets able to cover the current liabilities is that much higher. We could talk about the size of the current ratio, 1.08, if we had a comparator, but we don't, okay? And then we've got other things. We've got trade payables. Trade payables has gone down by 7 days. What does that mean? And trade receivables has gone down by 2 days. What does that mean? An inventory holding period has gone down by 4 days. What does that mean? So what we need to do is to have an opinion for each one. So if we were looking at, say, trade payables here, what could we say? What does this mean? This means that we've paid more quickly than we've done before. Is that a good or a bad thing? Well, what I would typically do with receivables and payables is talk about the traditional trade cycle of 30 days that we would expect to pay within 30 days. And this suggests that we are broadly doing so, which is ethically correct. But from a credit worthiness perspective, the importance is that it doesn't look like the company is having difficulty paying its bills. Okay, which is a good thing. Trade receivables, it's collecting them a couple of days earlier. Now, what does that suggest from credit worthiness? Well, it suggests that we have an effective credit control in this company. An effective credit control is fundamental to the company having cash. So it suggests that they are being effective in collecting their debts, which means that they've got less chance of the risk of running out of cash. An inventory holding, well, okay, inventory holding has dropped by 4 days. The less we hold in inventory, the more efficient we are, which is a good thing, okay? So what we're saying here in liquidity is good, 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 yes? And we would just have to discuss each one in turn. 4 ratios, 4 comments, we can reasonably expect to get something like 6 to 8 marks here for very straightforward observations. Finally, we have gearing. Now, if we're looking at gearing, what are we talking about here? We're looking at something like debt to equity, yes? Okay, it is identified elsewhere, but debt to equity. And what we see is that debt to equity has reduced, yes? It's reduced significantly. Now, why do you think it has reduced? Well, okay, let's go back a step. Is it a good or a bad thing that it's reduced? Oh, it's a good thing because it means that there is a substantial reduction in financial risk. So that's a good thing. Good, good, good. Yes, we've got a comment there. But we then have to say, well, okay, it's reduced. Is there a specific reason why it may have reduced here? Well, the fundamental reason why it's reduced, it goes back to that operating as opposed to finance lease thing. We got rid of finance lease elements, which means that we could reduce the amount of debt, the borrowing in the balance sheet. And now we've got operating leases. So we've got to ask a big question mark there as to whether or not there has been a change for the better, or is it just a case that we've now got hidden debt? Because if you remember, we had that last piece of information telling us that we have lots and lots of off-balance sheet finances. Yeah. So we've got all of these, and each time we're going to say, what has happened? Is it good and bad? And then saying, so what? What does it all mean? Once we've done that, then what we've got to do is to come to a big picture conclusion. And the big picture conclusion that we have here is very straightforward. It is going to be something along the lines of this. Fine, the numbers say everything's okay, but we now do not have finance leases on the books. And these finance leases could run for, these operating leases could run for up to 5 years. So I think we need more information about the operating leases. So that's the sort of thing that we have to do. I hope I've given you some understanding as to precisely what it is you have to do to be successful here. The key is, first of all, a basic observation of, is it good or bad? Secondly, to say, so what, and keep on saying, so what forevermore. Fantastic. Thank you for watching.